Hello everyone, and welcome to this new video about the 4 most famous investment portfolio strategies. We're going to break each one down before analyzing their returns. First, we need to define the investor profile and how to determine yours. Then we'll look at the John Bogle portfolio, also known as the classic 60-40. After that, we'll move on to the Ray Dalio's all-weather portfolio, followed by Harry Browne's permanent portfolio. We'll finish with the Tyler Butterfly portfolio. Let's start and see how to determine an investor profile. There are 4 key questions to ask yourself before figuring out what type of investor you are. The first one is about your situation. Do you have a family, like dependent children? Do you pay rent? What about your income? Is it fixed or variable? Do you have debts? Any emergency savings? And how old are you? Next, we'll look at how you manage stress to understand how comfortable you are with financial and market fluctuations. Are you okay with seeing your investments drop by 10% without panicking? Then we'll focus on your objectives. Are you a long, medium, or short-term investor? Are you looking for quick profits or long-term growth? And finally, your contributions. What's your initial capital and how much money can you invest each month? Once you've answered these 4 questions, you'll be able to figure out your investor profile. The first type is conservative. You're looking for low risk. The second is balanced. You're okay with moderate risk. And the third is aggressive. You can handle high risk and you're aiming for strong returns. Just a quick note. If you're a young people, you must take risks. Okay, now we're going to analyze the John Bogle portfolio, also known as the classic 60-40. First, a few words about the author. John Bogle was the founder of Vanguard, one of the world's leading investment firms. He also created the first index fund and was a true pioneer of index investing through ETF. Let's look at the 60-40 allocation. As the name suggests, the portfolio is split into 2 parts. Stocks make up 60% of the portfolio, and intermediate bonds represent the remaining 40%. Intermediate bonds are bonds with maturities ranging from around 3 to 10 years. Let's analyze the return of this portfolio. We're going to backtest it using a very powerful and free website called Portfolio Visualizer. Once you're on the site, you click on Analysis, and you'll see a bunch of different tools to backtest, analyze, and play around with portfolios. The feature we're interested in is called Backtest Asset Allocation. Just click on it, and it'll open up this page. So here, we have one portfolio, and we can edit it. By default, it's already set to 60% US stocks and 40% intermediate-term treasury bonds. We can name this portfolio 60-40. If we click on the settings, we can adjust backtest parameters. For the time period, we'll choose the earliest available year, which is 1972, and run the backtest up to today. The initial investment is $10,000, and we'll assume we contribute a fixed amount of $100, adjusted for inflation of course, per month. The portfolio is rebalanced every year. Let's analyze the results. Here's the asset allocation. And below we have a performance summary. After 50 years, the portfolio grows to over $4 million. With an average annual return of around 12%. The best year had a return of 30%, and the worst year saw a loss of nearly 17%. The maximum drawdown was about 28%, which means at one point, your portfolio dropped by that much from its peak. You can also find the Sharpe and Sortino ratios. Now let's look at the equity curve. We can see a steady upward trend, rising to 4 millions. The histogram of annual returns shows that the average yearly return hovers around 12%. You can also spot major market events. The 2008 financial crisis, due to subprime, the Ukraine war in 2022, and the oil crisis back in the 70s. Scrolling down, we find more detailed stats. And here, we have drawdowns. It's clear that the maximum drawdown happened during the subprime crisis. Finally, if we look at the portfolio return decomposition, we see that US stocks performed much better than intermediate-term bonds, but they also carried significantly more risk. In fact, they account for more than 90% of the total portfolio risk. Here, we have return per assets. And down here, we have plenty more stats to explore. Some people might say that 40% in bonds is too much, and that's actually why John Bogle came up with an alternative rule. Instead of investing a fixed 40% in bonds, you invest a percentage equal to your age. So for example, if you're 25 years old, you'd allocate 25% to intermediate bonds and the remaining 75% to stocks. This approach allows younger investors to take more risk, while older investors gradually shift to a more conservative allocation. So now, let's backtest this version of the Bogle rule for a 25-year-old investor. Let's go back to Portfolio Visualizer. We edit the portfolio and rename the second accordingly. For a 25-year-old investor, we allocate 75% to stock market and 25% to intermediate bonds. Now we have two portfolios, the classic 60-40 and the Bogle rule version. When we compare the two, we can see that the end balance is higher for the Bogle rule. Since stocks have higher returns, this makes sense. We generate an average return of 12.67% per year. But be careful. The worst year is also much more painful than the 60-40. You could lose up to 25% of your money in a single year, with a significant drawdown. If we compare the equity curves, the Bogle rule outperforms the classic 60-40 over the long term. But again, if we scroll down to drawdowns, we see that the maximum drawdown for the Bogle rule hit negative 37% during subprime crisis. So yes, it's a more aggressive approach, and while it can deliver better performance over time, it also comes with more risk. Warren Buffett, one of the most famous investors in the world, also proposed a variation of the 60-40 strategy. His approach is much more aggressive, with 90% allocated to stocks and only 10% to short-term bonds. Short-term bonds carry less risk than intermediate bonds and have a maturity between 1 and 3 years. That is why Buffett prefers them. They provide some stability while keeping most of the portfolio exposed to the stock market's growth potential. Let's add the Buffett portfolio to our backtest. I rename the portfolio 3 accordingly. We allocate 90% to the stock market and add short-term treasury bonds with a 10% allocation. Let's analyze results. Just a quick note here. The start date of the backtest shifts to 1977 because short-term treasuries don't have as much historical data. So, keep in mind that the nominal results of previous portfolios have changed. Now, if we look at the performance summary, we can see that the Buffett portfolio ends with a higher balance and a better annualized return, around 13% per year. But it also comes with a lot more risk. The worst year saw a loss of nearly 33%, and the maximum drawdown hit negative 45%, which is massive. So clearly this portfolio doesn't perform well during crisis periods. Looking at the equity curve, we can visually confirm that the more stocks you have, the better your long-term performance. But also, the more extreme the drawdowns. That's why the Buffett portfolio delivers the best returns, but also suffers the worst drops. If we click on the drawdown chart, we can see that during the subprime crisis, the portfolio lost almost 46% of its value. So, if your investor profile is moderate or conservative, this kind of portfolio isn't really suited for you. Let's now take a look at a strategy that's more resilient during financial crises. It's the Ray Dalio all-weather portfolio. A quick introduction to Ray Dalio. He's the founder and chief investment officer of the world's largest hedge fund, Bridgewater Associates. He's been investing for decades and is also the creator of the all-weather portfolio. Its allocation is designed to perform well in all economic environments. It includes 30% in stocks, 40% in long-term bonds, meaning bonds with maturities over 10 years, 15% in intermediate bonds, and then 7.5% in gold, and 7.5% in commodities like oil, gas, and so on. The latter perform very well in the event of rapid inflation. Okay, let's backtest the all-weather portfolio using Portfolio Visualizer. I add the portfolio to compare it with the classic 60-40. Let's set the right allocations, and let's analyze the result. Just note that the backtest starts in January 2007, so we won't have as much historical depth as with the previous portfolios. Now looking at the performance, we can see that the all-weather portfolio ends with a lower balance compared to the 60-40. The annualized return is about 11.5%, which is slightly less. But when it comes to risk, there's a big difference. The worst year is pretty similar for both. But if we focus on the maximum drawdown, the all-weather portfolio only drops around negative 20%, while the 60-40 falls as much as negative 28%. So clearly, the all-weather portfolio is more resilient. If we check the equity curve, we notice that 2022 was a rough year for both strategies. That's because, in theory, stocks and bonds are supposed to be negatively correlated. But in 2022, due to rising inflation and aggressive rate hikes by central banks, long-term bonds dropped alongside stocks. So instead of protecting the portfolio, bonds actually amplified the losses, leading to a rare situation where both asset classes fell together. Still, over time, both portfolios show solid performance, around 11% annual returns. And if we dive into the drawdown chart, we can see that during the subprime crisis, the all-weather portfolio clearly outperformed the 60-40 in terms of stability. It was a good portfolio to have during this crisis. It was almost 2 times more stable than the 60-40. Okay, the next portfolio we're going to look at is the Harry Browne Permanent Portfolio. Harry Browne was an author, politician, investment advisor, and a strong advocate for free markets and free people. He was also the Libertarian Party's presidential nominee in both 1996 and 2000. His portfolio strategy is super simple and designed to handle any type of economic condition. It includes 4 different asset classes, each with a 25% allocation: stocks, long-term bonds, gold, and cash. The idea is that no matter what happens in the economy, growth, recession, inflation, or deflation, at least one of these assets should perform well and help stabilize the portfolio. Let's compare the permanent portfolio to the classic 60-40 and the all-weather. We add it to Portfolio Visualizer, right here, and set the allocation correctly. 25% each in stocks, long-term bonds, gold, and cash. Once that's done, we run the analysis. Here, we've got our 3 different strategies side by side. If we check the performance summary, we can see that the permanent portfolio performs slightly better than the all-weather, but less than the 60-40 in terms of total return. The annualized return is around 12%, which is still solid. But what really stands out is its stability. The worst year is only minus 12%, and the maximum drawdown is just minus 15%. That makes it by far the most stable portfolio among the 3 we've tested. Looking at the equity curve, you'll notice the permanent portfolio performs better than all-weather, and holds up much better during rough years like 2022. While all portfolios suffered, this one lost the least, as we can see on this chart. And if we go to the drawdown chart, we can see that during the subprime crisis, the permanent portfolio had slightly lower drawdowns than the others. Same story in 2022, with inflation and the war in Ukraine. Financial markets were really shaken, but this portfolio only dropped about 15%. So overall, it's the most stable and resilient strategy we've looked at so far. The last strategy we're going to study is the golden butterfly, created by Tyler. This guy is a mechanical engineer, investing researcher and founder of the well-known website PortfolioCharts.com, a site that compiles tons of portfolio strategies. So, Tyler decided to build his own strategy, the golden butterfly. The allocation is pretty unique and well-balanced. It includes 20% in large-cap stocks, 20% in small-cap stocks, 20% in long-term bonds, 20% in short-term bonds, and 20% in gold, which is especially useful in times of inflation. What's interesting here is that although 80% of the portfolio is split between stocks and bonds, Tyler adds some nuance by diversifying across both market capitalizations, large and small, and bond durations, long and short term. Let's study this portfolio performances. So we move over to Portfolio Visualizer and backtest the 3 portfolios starting from 1978. We're comparing the classic 60-40 with the permanent and the golden butterfly with correct allocations right here. The golden butterfly has a higher overall return than the permanent portfolio, but slightly lower than the 60-40. Its annualized return is around 11.71%. When we look at the worst year, it's more stable than the 60-40, but a bit more volatile than the permanent portfolio. Same story for the drawdowns. However, during financial crises, both the permanent and the golden butterfly portfolios clearly outperform the 60-40. These curves tell us that while the 60-40 might offer the best raw performance, it also comes with higher volatility and deeper losses in tough years. If we look at the annual returns, we notice that during certain crises, like in 2022, 2008, here and here, the golden butterfly is riskier than the permanent portfolio, but still far more resilient than the 60-40. And if we scroll down to the drawdown section, that confirms it. The golden butterfly experiences deeper drawdowns than the permanent portfolio, but much less than the 60-40. So overall, the golden butterfly offers a nice balance. Solid returns with improved stability, especially during turbulent market conditions. Okay, let's wrap up this video with a quick review. We're going to classify each portfolio based on its investor profile. First, we talked about the classic 60-40. This is considered a balanced portfolio with a good balance between stocks and bonds. Then we looked at the Bogle portfolio, where you invest a percentage in bonds equal to your age. This one is also balanced, but it becomes more conservative as you get older. Next, we had the Buffett portfolio with 90% in stocks and only 10% in short-term bonds. Clearly a very aggressive portfolio, but one that aims to maximize returns. After that, we explored the all-weather portfolio by Dalio. This one is known as a balanced strategy, designed to perform well in different economic conditions. Then came the permanent portfolio from Browne, a strategy built specifically to resist all types of economic environments, with 25% in cash and only 25% in stocks. This one drastically reduces your risk, so it's a conservative portfolio. And finally, the golden butterfly. This is a balanced portfolio with a smart mix of stocks, bonds, and gold. Its performance is solid, while keeping risk fairly low. Alright guys, thanks a lot for sticking with me through this video, and I'll see you in the next one.